Happy Friday, Brian Manning here with your weekly update. Let's talk about it. Monday this week, not a lot of news on Monday, but stocks were still rolling from last week's rally and still from last week closing at all-time highs. So certainly still in a tear there, and we'll talk more about stocks here in a moment. Tuesday this week, we got some data from CoreLogic, primarily foreclosure-related data. And on a year-over-year basis, foreclosures are down 40%, foreclosure inventory down 40%, already at an incredibly low level and now just moving even lower. So really amazing to see what appreciation does across the nation with limiting the foreclosure process. And we also had Janet Yellen's testimony and speech. Started Tuesday, went through Wednesday, just getting drilled with question and answer. So, really important to say, I guess Yellen says she sees moving rates sooner versus later. Not shocked by this. Inflation is above 2%. The U.S. economy is already factored in as being fully employed based off of our unemployment rate. Everything about the economy shows that we're out of recession. This should have been done a while ago. I really think the Fed should have raised rates more than they have right now. Yellen's certainly starting to lose some credibility with what's going on out there because they keep talking about raising rates, but they haven't done it. We got a meeting coming up here in March. We'll have to wait and see what happens. But I wouldn't be surprised if we start seeing rate hikes sooner versus later. Also, really important, we talked about this last week, did make some comments about the bond buying program. So when the Federal Reserve came to our rescue and had the recession bailout, quantitative easing, it was 1, 2, and 3, and all the other variations in between, they still now have a very large balance sheet of mortgage-backed securities. On a weekly basis, the Federal Reserve right now is reinvesting anywhere from $8 to $9 billion into the bond markets, with specifically purchasing mortgage-backed securities. Well, Yellen did say that they see themselves phasing out this program towards the end of the year. This bond buying that they're doing right now is artificially keeping mortgage rates low as well. So when the Federal Reserve does start to taper out of spending $8 to $9 billion a week on mortgage-backed securities, that also is going to start to put pressure and mortgage rates will go up as well. So we need to keep close eye on what the Federal Reserve is doing here. Not a lot of talk about it, but something to really pay a lot of attention to. Also this week we got CPI, Consumer Price Index, measures inflation on a consumer level, up to 2.5%. And the core rate, which is really important, it strips out very volatile food and energy. Core rate is from 2.2 to 2.3%. Again, we're just seeing continual increase of appreciation, something the Federal Reserve should look at and do something about. Today, quiet news day. Stocks are finally taking a breather. Certainly seems on a global level that they're realizing that maybe part of their speculation and the fuel in the fire for stocks has been over what the administration may do here in the U.S. or how quickly they may act. It's really nice to see stocks take a breather, helping us out and get a little bit of improvement in the interest rate markets here as well. I'm around all weekend. You have any questions, let me know. Love to help you. Love to be part of your business. Happy Friday and have a great day.